Hey traders. For this lesson, we're going to examine the differences between being long and short, as well as explain how shorting actually works. We will also examine some rules and regulations related to stock buying and selling, or longing and shorting. First off, we will simply define the differences between long and short. Being long in any stock simply means you purchase a stake in that company from a seller. You now own this position and can sell it when the time comes to close out of the position. Your profits or losses can be calculated by taking the sale price and subtracting this from the purchase price. In order to be profitable in a long position, the price of the stock must go up. Being short in any stock means you are selling stock to a buyer that you do not actually have. In order to sell stock that you do not have, your broker or clearing firm must have this stock available to be shorted. Basically, what is occurring is you are borrowing this stock from someone else who is currently long. You are then selling this stock on your own account. Your profits or losses can be calculated by taking the sale price and subtracting it from the purchase price. In order to be profitable in a short position, the price of the stock must go down. A few terms associated with being long and short are buying, selling, shorting, and covering. Buying is when you are going long in a stock and you are initially opening your position. Selling is when you are closing out of your long position in a stock. Shorting is when you are selling stock to go short and you are opening your position. Covering is when you are buying stock to end or close your short position. Most people, especially investors, have a negative feeling towards shorting. In fact, in September of 2008, during the market crash, shorting of stocks was outlawed by the SEC. It is important to acknowledge that shorting of stocks is an important and critical aspect of a healthy market system. In early 2009, the SEC voted to possibly reinstate the uptick rule. For those of you who don't know, the uptick rule states that you cannot short a stock unless the last sale price was on an uptick, or it was higher than the previous sale. This rule existed for decades but was recently abolished. When shorting stocks, different brokers also have different regulations. For example, some brokers do not allow stocks under $5 to be shorted. Others have different margin requirements for shorting of stocks that are at different price levels. It is also important before you try to short a stock to ask your broker if they have a list of stocks available to be shorted. Most direct access brokers will have a symbol on the level 1 or level 2 screen which indicates whether or not a stock can be shorted. That was a brief overview of the differences between going long and short, as well as some of the implications of the two. For our next lesson, we will examine how account size and margin influences your trading. Until then, and as always, we wish you the best of luck with your trading.